Welcome, everybody, once again to another episode of Fixated on Real Estate Experts Live. I'm your host, Tarl Yarber. We will soon be joined by our guest. Now, this episode is much like all the rest, very, very, very important, but more so than ever. And for some of you guys watching this, you might be at a point in your investment career where you might not be thinking that asset protection and tax strategies and entity setups and all that stuff is something that's not right for you today yet. A lot of us in the real estate world, we don't start getting hardcore about our asset protection, our entity structures, our tax setups, our S Corps, C Corps, LLCs, all that stuff until after we're already knee deep or sometimes neck deep or sometimes completely underwater in properties, income, tax issues, all that great stuff. Then we realize that we actually need help in our entities and tax strategies. Well, I'm here to tell you personally, I was actually that investor. I invested for years before I finally started paying the professionals, the experts, to figure out my tax and asset protection for me. And it's one of the biggest regrets I have. So we have today's guest, Clint Coons, who you're going to learn a lot more about him here shortly from Anderson Advisors. He's my personal asset protection attorney, my personal tax strategist, and you're going to get a wealth of information from him. This episode has so much info in it. It's incredible. At the end of it, you're going to hear Clint offer a tax and asset protection strategy session for you guys for free that he can do with you, and him and his company, Anderson Advisors, can do with you. There's a link. I'll give it to you right now. It's ABA, which stands for Anderson Business Advisors, aba.link, L-I-N-K, /SS12. That's aba.link/SS12. Definitely check it out. It's free, no obligation. And by the end of this episode, I promise you're going to want to talk to him and his company. They've saved us a ton of money over the years. And I'm definitely very happy to have him as my attorney and all these things. I'm bringing him to you guys today. So let's hear it from Clint Coons. Hey, everybody. I'm Tarl Yarber. Welcome once again to another episode of Fixated on Real Estate Experts Live. I am here with my beautiful perpetual guest, Jay Scott, who missed us last week. Where were you, Jay?
I was at a BP headquarters in Denver.
Really? Bigger Pockets headquarters. What was that like? Was everybody together, or were you guys?
Because I flew in, I forced a bunch of people to violate their COVID quarantine rules and come into the office. So,
well, you are from Florida right now, so I guess like you just brought Florida to Denver. So you're supposed to do.
Off.
Awesome. So Jay and I are actually super stoked to have Clint Coons with us today with Anderson Advisors, and we're going to get into Clint in a second. But this is going to be a good show. This is actually one of those topics that Jay and I actually do talk to each other about. And we actually have had whole conversations about tax strategies and asset protection. And there's been a few of these shows where one of us might start going off into the weeds of some of it. We could finally legally do that today because we have my asset protection attorney and my tax strategist advisor, Mr. Clint Coons, with us. And we're excited to have him. And he's going to blow all our minds and make us all realize that we are spending way too much money on the government. And maybe hopefully he could teach us that. I don't know. And definitely find some ways to protect our assets as we're building them up in the real estate world. So I'm going to introduce Clint with his fancy resume because he is an attorney. So it's nice and long. And he's got all these like asterisk things behind his name. And let's go ahead and start introducing Clint. First off, Clint, how are you doing, man?
I'm doing well. Thanks for having me on. I mean, with just what you said about me to begin with, I'm looking around going, who the hell is that guy he's talking about?
You. Let's get official. Let's talk about who you are. So Clint Coons is a partner. Are you the founder or are you one of the co-founders of Anderson Advisors?
Co-founder. Myself and my partner, Toby, started it.
Awesome. So as a partner, Anderson Advisors, Clint Coons Esquire is a real estate asset protection expert, avid real estate investor, and author of Asset Protection for Real Estate Investors. Clint has grown his legal tax firm, Anderson Advisors, to over 200 employees by assisting real estate investors with creating and implementing solid entity structuring plans. His success in these regards is a large part to his personal investing experience. Believe it or not, Clint actually has acquired over 100 properties from single family to commercial buildings. He's also a successful attorney, real estate investor, and speaker. Clint has used his innovative and dynamic strategies to help thousands of people save millions of dollars and build real wealth. That's you. That's the guy here today.
What's the believe it or not? Why wouldn't we believe it?
We're on YouTube and Facebook and everything's true, I guess. So it's all good. So you should believe us.
I mean, it is from here for this group. Believe everything we tell you.
We all believe it. It should be true then, right?
It is true. Mm-hmm. I'm very excited. Actually, Clint is the guy that set up a couple of years ago. I was just like every other house flipper out there who was doing my own thing, flipping tons of houses, stacking cash. And we did a pretty good job on our taxes, and we did some things really well in our entity asset protection, but a lot of it was self-done and self-taught. And some of you guys watching this and listening to us right now might be that same boat where you're kind of like, you maybe have an LLC or you have an entity, maybe you're doing some things that you think are right because you heard one of these videos before, listened to somebody talk, and tried to save money somewhere. Then a few years ago, I'm like, I gotta get this done really right. And Clint came in and taught us how to really do it really, really well. And they run all our asset protection stuff now for my wife and I and all our companies, and also gives us great tax advice and tax strategies to save money. Now, Jay Scott doesn't use them yet. And so we'll see.
Let me tell you something. There are not a whole lot of great tax attorneys and tax advisors for real estate investors out there. I have a good one. I have one I love. I didn't know Clint when I found mine. So, but I would highly recommend, if you find somebody that you hear is good, latch on, because there aren't a lot of great ones out there.
And then confirm that they're actually good too.
Yep.
So Clint, welcome to the show. And of course, Jay, I'm not going to read your long bio because I read it every single week. And we're just going to skip that for now.
Perfect.
We're going to do this kind of more like an informal way today. We're just going to jump into some questions with Clint because it's the end of the year. We're going to, it's the end of 2020. And there's some things that maybe we could still do in 2020 as real estate investors to be able to help ourselves out, to take advantage of things before January hits. But we can also do some things as investors going into 2021 that might set us off on the right foot if maybe we're doing some things inaccurately. But before all of that, Clint, I just want to ask you some questions. Like if you came up to, or if I'm a young aspiring and real estate investor of some sort, and I just called you up one day and said, hey, I need help, what would you want me to do? What would you be talking to me about? How would you talk to me? What kind of advice? What kind of mistakes have you seen guys like me make before that might like mess us up big time in the future that you see all the time? Maybe we start with that. What's the biggest thing that you see us do all the time to screw things up as real estate investors?
Well, most people, the thing I see a lot is that people go to Nevada and set up an entity and think that that's what they need for their real estate investing. And that's the wrong way to approach it. And that's why I tell people, like I said, you say you're a real estate investor, but what type of investor do you want to be? Do you want to wholesale? Do you want to flip? You're going to do single family, multifamily? Is it going to be self-storage? What areas are you focused on? And then you want to know where you're going to be focused with your real estate investing. So I like to back into it, the planning. So we determine what type of investor you are. Then let's look at what would be the right structure around that. And if you sat down and you said, you know what, I haven't bought a single house yet. I'm just exploring. I don't know if I'm even going to be serious about it. Well, then until you've decided that real estate investing is something that you want to do, there's no need to set up an entity. And that's the common mistake that I think a lot of people take away from even coming to my own events. You know, I'm upfront with people. I tell them, hey, I'm going to peddle fear for about an hour just to scare the hell out of you. And there's a reason for it. I'm not ashamed to do it, because if you don't know where the risks are, then you're not going to plan for those risks, and they're going to sneak up and hit you upside the head one of these days. And you're going, wow, I wish I knew that. But people tend to take from that, oh, if I don't do this right now, I'm going to get sued from that tenant because they discover mold on the property. Well, wait, stop. You don't have a property yet. So why are you worried about a tenant that you don't even have? So that's the way we approach it. Is we want to make sure that it's right for the particular type of investing you're getting started.
Yeah, we talk about that a lot as just regular investors. Like, we're just like, what are you actually investing in? What is your focus? What is your goal with investing in real estate to begin with? And most, especially people starting out, they're just trying to do everything, right? Mm-hmm. And they don't really have a direction or a plan to begin with. And it just comes back to like, how do you know what entity structure you need if you don't know what you're going to be doing, or you don't know what you're doing currently in real estate? So that's there's another reason to know what you want to do in real estate, right? Then and there.
Absolutely, there is. And so then you start exploring, what your objectives are. Is it asset protection? Is it tax planning? Is it being able to qualify for lending? And what I find with a lot of people, not the newbie, well, even the newbie investor, let's say that, but they have a good W-2, they're making really good income, and they want to reduce their taxes. Mm-hmm. And I always have to caution them. I said, yeah, you can do that. And I did that for years. I wiped out all my tax liability, but it doesn't help with you when you're growing your portfolio. And I have to tell them there's multiple sides to setting up structures. You should set up a structure that's going to help you, expand your business, qualify for financing, and it's not going to hold you back. And I see a lot of people putting stuff in place that they just don't realize the long-term ramifications of those structures when it comes to dealing with third parties.
So let's talk about that then. And Jay, you can jump in. I'm just going to keep going. But
oh no, I love this. I'm always giving tax and legal advice with lots and millions of disclaimers because I'm not a tax or legal professional. So I love having somebody here that like can teach me. So this is great.
Yeah, I'm excited because like it gives us the permission to actually talk about this stuff for once.
Yeah.
So let's talk about structures then. Like let's just start at the beginning and do some nuts and bolts stuff for people. So for those of you guys that already have a ton of properties and you got this all situated, don't worry, we'll get into some cool advanced stuff potentially later. And there's definitely going to be an offer that Clint has for you guys that you're going to want to stick around for the rest of the show. He's going to do something he usually doesn't do for you. But before that, let's just go to the nuts and bolts. Let's just start at the beginning. If I'm buying flips or if I'm buying rentals, like what should I be doing for my entity? Should I have LLC? Should I go get a C corp? I heard. Should I put
and
all my
even
stuff
start
in
at the
name?
beginning? Like what is an LLC and what types of LLCs are there and how do they differ from corporations? And
let's get nitty gritty. Let's start. Right. This is a football. Let's just talk about that, right?
So, the limited liability company, it's probably one of the most popular forms of conducting business in the United States right now because it is very flexible in its creation and the operation of it. An LLC is similar to a corporation in that it offers liability protections for the people who run and operate and own the LLC. That means if something were to happen inside of that LLC with your rental property, if you're the manager and the member, you're not going to be sued unless you're like my father. You're the one managing it and you go out to the property and you instruct your tenant to get up on the roof and help you repaint the property and he rolls off the roof and he injures himself, right? And he was working for reduced rent. Now you realize, hey, I got a problem here. So in those...
Wait, that's a problem. You shouldn't do that.
I didn't know that was an issue.
Yeah.
Yeah. Outside of those unique circumstances, those outlier situations, you're going to be protected. And that's how a corporation and LLC, what they're designed to do. But then on the outside, that is, if you're sued individually, there's a difference between those two. If you'd set up a traditional corporation, you have shares, someone can take those from you if they get a judgment against you, whereas a limited liability company offers you a little more protection depending on your state law, where you actually create the entity, whether or not state law allows a personal creditor to attach your company and possibly force a dissolution of it. So from that standpoint, we like this structure because it protects not only from what happens with the asset itself or with the business activity, but it also protects the business from external threats that your family may fall into that creates liability. So that's a quick synopsis of those two entities. And then what it comes down to for most individuals is how you're going to treat it from a tax standpoint. Because an LLC can be treated as a C Corp, S Corp, partnership, or what we call disregarded entity, which means it doesn't have to file a return and everything passes through to the members and shows up on the members' tax return. And the member could be another entity, it could be an individual, it could be a solo 401k, an IRA, it doesn't matter. So what I look at, you bring up two things. You say, what if you're going to flip property? So what do flippers, you have to ask yourself, what are their problems? What are the challenges they're going to face when flipping property? Well, obviously liability.
Contractors,
yeah. So what does that mean? You got to find better contractors. In a market like this, that's tough. So develop your own team. So you've got this inside liability covered. So if anything goes wrong with the flip itself, you're not going to be held personally liable unless you're the one doing the work. So that's covered with the LLC. Well, what about taxes, which is the major problem for people who are going to flip property? Because if you flip real estate and you do it in your own name, that's considered active income because it's an active activity of buying and selling property is considered active by the IRS. So it shows up on Schedule C. That means you're going to be subject to employment taxes on all of that income because it's active income. It's like a salary. So that's an issue. You're going to pay potentially more in taxes when you run your business that way. So if you want to minimize that, then we want to look at some form that would keep the taxes coming down to us, either prevent it from all hitting us or minimize the employment taxes. The other issue that flippers...
So can I stop right there for a second? So like on a personal story on that level, years ago, now I did have a CPA that told me how to do this before talking to you, Clint, years ago. But I remember, so for those of you guys who don't know, like I was a financial planner commission only for a very good chunk of my young life, about 7 years or so. And I was used to paying self-employment tax, right? So I would get active income from all my commissions, but because you're not paying employment tax because I was an employee, I paid self-employment tax, which was like 15.2% or whatever, right? And the independent, and also state of California where I was, they took more money too. So when I went and started flipping up throughout, everywhere, whatever, it's an active income. So in my head, I kind of thought that that's still employment tax, or self-employment tax would be involved anyways. And so I didn't think anything of it so what you basically just said is that if you don't set up some sort of structure, you're getting income almost like you're self-employed, and you're going to pay that self-employment tax. And am I correct in that? So
Sure.
I had a CPA, which is what Clint's getting to. I'm hearing is that how do you get rid of that self-employment tax, so that you don't pay that 15.2% or whatever that number is today, in self-employment tax, and that's through setting up the right entity structures. Correct.
It's through choosing the right tax selection. And most people that I have run into, that do this, that have worked with another professional, they set up S corporations, or they have their LLC taxed as an S corp, because the CPA will explain to them, listen, if you make $100,000 and you had 15.4% employment taxes and you ran it as a disregarded entity, you would pay an additional $15,000 in taxes this year. But if we set it up as an S corp, I can cut your tax liability in half, because you'll take a salary, a W-2 out of your S corp LLC. You'll pay employment taxes on that, but the other part will take as a distribution, and that distribution would escape the employment tax. So that's about a $7,500 tax saving. And people buy that. I mean, they drink that Kool-Aid all day long, and because they get so hyper focused on, I'm saving $7,500, that they fail to see the forest through the trees, and they don't understand, you may have other motivations here, or what you want to do with your business, and to solely focus on tax can be detrimental to your overall business growth. And here's why. You're a flipper, okay? Unless you have tons of cash, you're probably using hard money lenders or private money lenders. You don't have access to traditional lenders because they're just scared to death of flippers. They don't want to work with them because they've been burned with them in the past. So it makes it very difficult to establish a relationship unless you have experience and a track record to get a lender, to a conventional lender, to loan you money on flips.
Sorry, I got too many stories.
Go right ahead.
Dude, you keep interrupting. I want to let him get to his point.
Hey,
no, this is his point.
As long as they're not too long, because I'm blonde and I forget what I'm talking about.
No, this is good. This is good. I went to my bank, one of the big box store banks that I love, actually, right? I bank with Chase. And my company at the time, that we don't run everything through Fixated anymore, but we used to, had years of track records, hundreds of properties and stuff. They wouldn't look at me twice, as far as like I was trying to get like a business line or some sort of commercial line or something like that through that company. They wouldn't look at it at all, right? They're like, house flipping, we're not really into that. But I had my Fixated events company, which was just started. It made 30 grand that year. And they were willing to give me almost a $200,000 business line of credit on a events business that barely just like did anything. And they're like, oh yeah, we'll lend on that all day. Like, what? This business over here, my real estate business, makes a ton of money. It has years and years and years of track record, and they don't even look at it. But my little shitty events business that just started, like, they're like, oh yeah, we'll give you lots of money for that one. But anyways.
See, so that's the problem that investors have, is that when information passes down to your 1040, if you're going to apply for a loan, banks are going to ask for copies of your 1040. And when they look at your 1040, they're verifying income, and they want to see what you do. If you flip properties, it's showing up on your 1040. If you are flipping through an S corporation, it's showing up on your 1040 because you're getting a K1. So what ends up happening is you end up providing way too much information to lenders when you go into to obtain loans to get financing on real estate, because they're going to know you're in the business. So one of the strategies that I'm a proponent of is to run these types of activities through a C corporation or an entity taxed as a C corp. Number one, the reason why. None of it hits your 1040 unless you want it to hit your 1040. And the way it would hit your 1040 is W-2 income. Now, granted, you're not saving on employment taxes like the CPA told you would save if you ran it through an S corp, but the CPA doesn't understand that I'm not in this just to save on taxes. I'm in this to build wealth. And if I just focus on the taxes, I'm going to prevent myself or hold myself back from really pushing that business as far as I want it to go, because I'm still going to work with HMLs and they're still going to take a huge cut out of my profits, and the carrying costs when you get stuck in a market where you can't move your property because you're held up with contractors or the materials and supplies aren't coming in yet. I mean, you look at what we have here in Washington. If you want to get a high-end appliance, you're 2 to 3 months out. I was just talking to one of the major builders here in the South End about this past weekend that I know. And so those are things that you're going to run up against. But when you have a C Corp, your lenders aren't aware of you're the activity that you're personally engaged in, because all you are is a W-2 wage earner. And you say, well, what the hell do you do? You know, I manage investments. I'm an investment manager, which is what you do with real estate. You're managing that investment as a director of that company. So it keeps the information privatized because nothing shows up on your 1040 other than the W-2 that you would get, let's say, if you're working for Microsoft. So you look better to lenders when you have a big W-2, which helps you qualify. The second reason, C Corps, they're taxed at a flat 21%. And for people who flip, the money's in the roll. So if you're rolling properties and each time you do a roll, you're losing, let's say between 37% highest personal income tax bracket, which you'd have with an S Corp, plus that 15% on top of that. Maybe you have a state tax on top of that as well. I mean, I think in California, you could be dropping at least 50 to 55% of your profits just in taxes. If you're a high wage income earner, why not cut it to 21%? Just flip through a C corporation, you're taxed at a flat 21. Now you have more money left to invest. And I hear I get on phone calls a lot with clients with their existing CPAs, and they'll tell me, oh, Clint, you got double taxation. It's like, no, really? We do? Let's do some numbers. And I would just throw out an example. You make $1 million. Show me the difference in tax rates on $1 million for an individual versus a C corporation. And when they calculate it out, they sit there and they come up with a number that is so small, the difference, it's negligible. And I say, well, I thought this was an issue for you. Why are we crying over $15,000 when I can put an additional $200,000 back in his pocket? And that's the mental shift that they sometimes struggle to make, is because they haven't analyzed it from the real estate investor standpoint. So for flipping, I like to use C corporations, and that's how I control my income. And any active business, I like to use a C corp.
So at what point though, at what point should somebody then look at doing a C corp versus an S corp as an investor if they're flipping? Should it be day one? Should it be day
one? I would never use an S corp. I ran my law practice as an S corp until they changed with Tax and Jobs Cut, and they allowed me to switch to a C corp, and they no longer penalized us as a professional service company for running it as a C corporation. And I've never looked back. What I've hated about growing my portfolio is that every time I deal with a lender, they always ask me the same thing. Hey, can I get a copy of your 1040? We need 2 years. You send them a copy of your 1040. They see the K1 for my law firm. Next thing I know, well, we need your law firm's tax returns. We need the balance sheet. We need the profit and loss. Oh, by the way, we're going to run a liquidity test on your law firm. Oh, what are these things on your balance sheet? We don't see a corresponding on your tax return. Something doesn't match up here. And you use your company, right, to generate tax deductions for yourself so you don't get killed in taxes. But that doesn't translate well to a lender who's looking for different things. When you use a C corp, none of that shows up. They don't know you're in business for yourself. They don't see it. They're not going to ask for it. You have to remember there's an underwriter back there that is scrutinizing returns. It's like people that do buy and hold. A lot of them are set up with disregarded LLCs, or they own them in their own name, and they're flowing down on their Schedule E, page 1. And many of the loans that investors work through, and when you're working through a broker, they're going to be Freddie, Fannie conforming loans. And so they're going to go through the same process that is required in order to sell that to one of those two institutions. Well, a Freddie, Fannie conforming loan requires that you hold back 25% of the income for vacancies. So if it shows up in your Schedule E, page 1, you're getting a 25% holdback. That's required if they're going to make it a conforming loan. But if you shift it and you carry that income through a K1, through a partnership, and dump it onto your return, you don't have that same holdback. I mean, that's their guidelines. You can go look all this stuff up. And so it tells me...
You just shift gears pretty dramatically there for a second. You went from C Corp to now a partnership with buy and hold.
Yeah.
So is there a good transition we can do to put a bow for the listeners and people like?
Yeah. So if you're going to flip property, you're going to wholesale active business. And even if you have an existing active business, I would tell you this, consider setting up a C corporation, take control over your income. I know that you want to save a little bit on the employment tax or the 199A, the flow through treatment. But at the end of the day, is saving on tax going to build the wealth that you're looking for? You may save $20,000 this year, but if you can reduce your tax or you can look better to lenders so you can do more deals, which one is going to put more money or more wealth in your pocket? And as I said, I've been there where I could not qualify for loans because I wiped out all my income through various tax planning maneuvers, and lenders wouldn't touch me.
And here's the other thing to say on that. I've been flipping out of a C Corp since my second year in business over a decade ago, because I got good tax advice from my CPA as well. And yeah, when you're making under, let's say 320,000, whatever the number is these days, you're not going to save on that self-employment tax as long as everything people talk about. And just to add a little color here, people talk about this double taxation. Well, you can pay yourself a salary out of your C Corp. That double taxation, that 21%, is only the amount of the net income that the C Corp generates at the end of the year. So if you pay yourself every penny in income as salary, which you're allowed to do because you're an employee of the company, you don't have you're paying 21% of zero. So you're not getting that savings on self-employment taxes, 50% or whatever that is over a reasonable salary at an S Corp. But you're not getting double tax necessarily. But the nice thing about a C Corp is it gives you more options. As you start to make more money, as you start to make $300,000, $400,000, $500,000, $1 million, well, then there are benefits to not paying yourself everything in salary. There are benefits to leaving some money in the business, which, yes, you'll end up paying a second tax. You'll pay that 21% on the retained earnings or whatever it's officially called. But there are benefits to doing that. And there are also benefits to just having a business set up as a C Corp, because you can take certain deductions that you can't take in other business structures. So I'm not really adding anything here except to say yes, I've been doing this for the last 10 years. And the more money I make, the more benefits I tend to see with the C Corp. So even if you're thinking, this might not be the most beneficial thing now, as you get better, as you make more money, you're going to start to see more and more of those benefits and options available to you.
Yeah, you know what? Just to put another bow on that, let me just share my screen out here.
Ooh, pictures.
Yeah.
If you guys are listening to this only, stare at your speaker because Clint's about to share something.
We're going to channel it through to you. All right. So here's what you can look at it. If I made $1 million, okay, $1 million in my own name, and I'm in the highest
grass,
37%, that equals $370,000 in taxes. Okay, let's do this. I know you got deductions, but I'm not going to worry about that. Now, if I did that same thing through a C Corp and didn't take $1 out, 1 mil out of a C Corp at 21% equals $210,000 in taxes. So that leaves me $790,000 left over. So if I take that 790 2 years later, I don't make any other investments, and I decide to distribute it out to myself. Out of a C Corp, it's called a dividend. So when I take that out as a dividend, that will be taxed at 20%. I'll just assume you're still in the highest tax bracket. So at 20%, what does that equal? Like 150,000?
It's the 190, I think. Right?
20% times
that's 190.
790.
180. 180.
158.
150.
Yes.
So what's 210 plus 158? $368,000. So 368,000 with double taxation, 370 with single taxation. I guess it's better to take single taxation.
So what is that 20% there? And it's funny because I've in 10 years, I've never taken a penny out of retained earnings from my C Corp. I was always under the impression that was going to be distributed as salary.
No, take it as a dividend.
So so it's 21% annual on whatever you retain, and then 20% when you distribute as a dividend.
Correct.
Beautiful.
All I got to do is just do the math. Now Now I show you these
Yeah,
numbers.
Jay, just do the math. Come on, dude. So.
Actually, it would be slightly lower because of 199A. You're going to get a deduction on that S corp pass through on some of that income. So, you might be looking at where the C corp you would pay an additional $50K more in taxes. But the point is this: it's negligible, because at the end of the day, what I'm focusing on is how much money do I have left over to invest? If I make $1 million, you're going to take 630 off or 370 off. You have 630K left for investment. Whereas when I'm in a C corporation, I have 790,000. This represents the difference between the tax rates here. So with 790,000, I can do more deals because I have more money. Plain and simple. Maybe you're no longer having to use hard money lenders at that point in time. So
that's before all your deductions too, right? As well.
Yeah. Well, actually, no, this is after. I'm figuring this is after you've already written it all off and we're down to that number. But you're right. If you want to take deductions, we can pull money out of that company tax-free to you. I was just working with a real estate investor last week. We were talking about it. I set them up on a plan where they have their monthly meetings at their house now, and they have an investment club. And of course, you have to wear your mask. So anyways, when they come over and they have their investment club, I said, hey, rent your house to your corporation. Let's pull about $30,000 to $40,000 a year out of your company tax-free to you under Section 288. I mean, let's use that business for your benefit. So having a C corporation also gives you opportunities for income shifting. Let's say you already have an existing business. One of the strategies we use at the end of the year, this other client, he has an S corporation that's set up over here. Here's his S corp, set up a C corp this year, right here in December. And now we have a marketing agreement where this company is going to perform marketing for this S corporation over here. It's going to handle scheduling as well. And there's a number of other things we listed there. And then what we did is we entered into a 1-year agreement where in order to provide these services, the C corporation is going to charge this corporation $200,000. But if they prepay it in December, if you prepay it, we will give you a discount of 15%. So to incentivize the S corporation to make a payment to the C corp to prepay these expenses of 185, we gave it that 15% discount. Or no, 15% is 170. We paid over. Why would he do that? Because in his S corporation, he's sitting on $400,000 of profit. So I just knocked off $170,000 in income to his S corporation. Now it's sitting inside of his C corp. It won't be taxable to his C corp until October of next year. So that gives us 10 months to figure out how we're going to spend that money or get that money out of there and not pay tax on it. So by having a C corp in your plan, it gives you opportunities. And that's what I often tell people is like, you got to take control of this. And if you continue on the same path, doing the same thing over and over again, it's never going to change. You have to think outside of the box. And that's the type of planning we look at.
Jay, you got anything you want to say to that?
No, it's absolutely true. The other thing, and this was kind of implicit in there, but I'll state it more explicitly, is that with a C corp, because any money that you leave in the company year to year, or at the end of a year, you're paying 21% tax on. If you make a whole lot of money, you might be in the 30, like Clint said, 37% tax bracket. Let's say you make $1 million. So you're cutting 37% of that income. That goes away at the end of the year. If you leave it in the C corp, well, 21% goes away. So you're saving 16% of that income that's going to hold over. You're eventually going to pay it because you're going to pay the dividend, the 20% dividend, but you're pushing that tax burden down the road. So it's just like a retirement account where the benefit of a retirement account isn't necessarily that you never pay tax on it. But a traditional IRA, you're pushing that tax off far into the future so that you can compound the money until you pay tax. And so the C corp allows you to do the same thing. You're paying less tax now than you would if you dispersed all that money to yourself, and that gives you the ability to compound that money further into the future before you pay that final dividend.
Absolutely.
And so now it looks like now we're going to shift to the buy and hold, because there are quite a few questions already. People are like, yeah, but what about rentals? What about rentals? A lot of what we just talked about was active income. And I definitely appreciate that strategy from a C corp charging an S corp. We have a C corp and we have a couple S corps. And so it is an interesting tool for sure. But on our buy and hold side, I don't know, me personally, like I do something differently. And I know a lot of people have questions about that. Like, should I have a LLC for every property? What state should I be doing this in? Do I need to incorporate it? Should I have it in my personal name? What happens if I have 10 houses and they're in this over here? Like, people have questions on this for sure, because a lot of people have rentals. And this is where I feel like this is where it gets all gummed up with the information that you get out there from attorneys and tax people and the CPAs. Is like, how do you structure your asset protection as a landlord, especially with single family? And then how does that also affect your taxes if you do it too well versus another way or whatever it might be, and also still get lending at the same time?
Yeah. So, with buy and hold, I often tell people, hey, one property per LLC. Now they say, well, why am I going to do that? Because the equity isn't all that much. I'm buying property in Alabama, Indy, North Carolina, and these homes I'm picking up are $70,000. Whereas if I bought a house in Seattle for 500, well, I don't know if that's even realistic, 750,000, I can see using one property because I have more at risk. Well, it depends on how you define risk and what you look at when it comes to investing. As a buy and hold investor, I'm up to probably 300 doors now. Those properties that I acquire with my partner, Toby, we're not buying to flip. We used to flip. We don't flip any longer. Now we buy and hold. And we're not buying for appreciation. I mean, the markets that I'm investing in, Winston-Salem is one of the markets I have a lot of investments in. There's not a lot of appreciation there, but there's solid cash flow that comes from that market. And so that's what I am most concerned about with my investing is I want solid cash flow. So when I'm considering putting houses in LLCs, it's not to protect my investment in the property, it's to protect the cash flow from the investment. Because let's assume that you had one LLC set up here.
As a side note,
yep,
we're going to have to go back to what you just said, just because some of us do both with ours, where I do a lot of BRRRR investing, buy, rehab, rent, refinance, repeat. So I'd love to hear your thoughts on then with, no, I want the high equity also, and I have the cash flow, so I need both.
Oh, I think that's a great idea. Don't get me wrong. The BRRRR method works great for individuals like to pursue that strategy. I don't pursue it. Mine is more about providing what we call affordable housing. That has been ours, veterans housing. We do a lot in that market. That's the new word, affordable housing for low income, I guess, is when I was growing up, that's what you would call it. And so what I'm looking for is that cash flow. And here's what I mean by that. Because let's say you had 5 properties here, and each of these properties, say they generate $1,000 each a month. So you're bringing in $5,000 a month off of your portfolio, which equals $60,000 a year. And regardless of what these properties cost, if each of them was $100,000, that's a $500,000 portfolio of their real estate, of which you may have only $250,000 in equity in that deal, or $200,000 in equity, which you tend to focus on. But if you look at the cash flow, I mean, if one thing goes wrong with this one LLC, you've just lost $60,000 a year in income. So let me ask you, what's the worst hit? $200,000 in cash, losing all your assets, or $60,000 a year? I mean, I think it's the $60,000 a year, because over 10 years, look what that's $600,000 you've just lost by grouping all of those properties together. But if you split them up and they're each in their own LLC, and let's say you have that tragic situation where you're being sued for wrongful death because you didn't have working smoke detectors because your tenant disabled them so they could cook their own drugs, but that doesn't seem to matter. So this is an actual client story. So now they're coming after the LLC that owns the property. The LLC has 4 other properties in it. You may think, well, I'm only losing my equity. No, you're losing the cash flow. So I'd rather give up, one property, which is $12,000 a year in cash flow, than 5 properties, which equates to $60,000 a year in cash flow. So that's the way I approach it. Now, that's generalized. I mean, I get it. Let's say you're buying a pool of properties. You're working with a lender like CoreVest or somebody that's going to come in on that deal for you and allow you to pick up that 30-pack or 20-pack, whatever it is. Then you're stuck. Then you're going to be investing through one limited liability company. And that's the way the lender wants it. So that's what the lender gets if you want their funds. So you always have to balance that against who you're working with. And then the way I like to structure these investments is I create the LLC in the state where the property is located. And then I have the LLCs owned typically by a Wyoming LLC. So they're all disregarded back to this one Wyoming LLC. And I use that for anonymity. So when I create the property specific LLC, say it was set up in Washington, Florida, wherever it is, they meaning creditors, tenants, attorneys can't trace the business back to me. So Wyoming provides this anonymity shield. They're one of probably 10 states that do not collect information on the individuals. I like Wyoming because they have strong laws there and they're inexpensive to set up. So I flow it back, all these properties in their separate LLCs through a Wyoming LLC, and that's where I put the owners. So if it was myself and my wife, Tracy, we own this Wyoming LLC together, and it owns all of our real estate investments through separate LLCs. But this LLC I have treated as a partnership. And I do that because I want K1 tax treatment from that. It's still a flow through, but this comes down to, again, what I was hitting on earlier. It's what I want the lender to see that I'm working with. I want them to see a K1. There's a couple of reasons for that. One, Freddie Fannie conforming loans, right? I don't want to hold back a 25% on my income. Won't happen with the K1. The second reason why I choose an LLC taxed as a partnership to hold my rental real estate is because as you grow and you're trying to get involved in larger deals, one of the things that's going to come up is, are you an experienced investor? Experienced investors tend to hold their properties through partnerships. Inexperienced investors tend to hold their properties on their 1040 in their own name. Maybe they're through an LLC, but the lender doesn't know this when they look at your tax return. So what I want to do is create this image that, hey, I'm one of those experienced investors, because as you grow in your loans and your borrowing, it becomes less about income to a point and more about experience in trying to qualify. So what are you going to do to convince that other lender that you're working with that you have experience as an investor? Yeah, your track record, your HUDs, I get that, but also how your tax returns look. They help build the story around what you're doing. So setting it up this way, I think, is forward thinking, that as you grow, this is going to help create your story so you can do more. And a lot of people who structure, they miss that part. And I think a lot of it has to do with the fact that they're not real estate investors. My partner and I are avid investors. We own property, multiple different types of asset classes. And, we working with lenders all the time. And so this is born, a lot from our own personal experiences and building our portfolio out over the last 10 years. And I saw a shift when I started making structural changes to what I was doing, how I was reporting my income, and how that was flowing onto my tax return. I did see a difference in the way I was treated. And so I passed that on to the clients. And now you can dump into this too, land trust. People wonder, what about land trust? Well, yeah, you can use land trust. They'll typically hold the property and you'll put property into a land trust and put it into an LLC. You use a land trust to avoid things such as transfer taxes. If you're concerned about your lender accelerating the note, then we'll use a land trust to hold the property. And then, because land trusts, except Florida, they don't offer any asset protection. So then you put your land trust into an LLC for that added layer. So it depends. You got to just really get down and know where the properties are located to determine what are the best types of entities to create around it.
So I want to go back to what you just said too about with the putting your properties into a partnership having flow to a partnership.
Mm-hmm.
And don't you need two people for a partnership?
Yeah, you do.
What if you're by yourself?
Get married.
Like personality.
Go find somebody else, right? I
go by Clint and Karen. No, so here's what I do in that scenario. One of the other things I recommend is that even though you're holding property, you may want to set up a corporation, C Corp. C Corp can do a couple things for you in this scenario. One, it establishes your other partner. So by setting up this C Corp, you create the other partner in your LLC. You give it a 1% interest, 0.5% interest in that. So now it's you and your corporation. You qualify for partnership tax status. The other reason why I like the C Corp.
Hold on. Sorry. Jay gets it. I see it. That might have been quickly, depending on where people are at with their experience level. He's saying, okay, you need an LLC partnership, right? He's saying, go do that in Wyoming, right? If you're by yourself, how do you get that partner? Well, he just said, create a C Corp. And you're like, okay, well, that's another entity. Yes. The C Corp becomes your partner in the Wyoming LLC in that scenario. But you're the owner of the C Corp too. But the C Corp's technically, legally another person.
The C Corp isn't getting the same tax benefit of the passive income, but it has such a small percentage of ownership that and correct me obviously if I'm wrong, it has such a small percentage of ownership that extra 25 cents or $25 you're not getting in tax benefit is inconsequential compared to the other benefits that you're getting from running everything through that partnership.
And I might be getting the weeds on this one, though. The only pushback that I would say on that one is that, well, then I'm obligated to file a tax return for the C Corp every year, too, in order to keep it going.
Can this be the same C Corp that you're using for flipping?
Absolutely, it could.
So
you're already filing.
It depends on how many properties you have. So keep in mind that I'm not suggesting that everyone do this. I mean, planning it's not a one-size-fits-all approach. So if you came to me with one property, I'm not going to say set up a C Corp, a Wyoming LLC, and a red box. And we're going to roll all that up together. Oh, that's more than you're down. So it has to depend on where you're at with your investing.
Yeah. Spend $30,000 to save, whatever on your one property. But the other question I had then, though, when it comes to this is, what if you already have this stuff set up but not all the way like you show, and you're talking about funding and financing with lenders? Is there a challenge with the transitioning, like where you have, like if you have tax returns from one entity, or everything's on your, let's say you are an investor that everything rolls up to your 1040. So that means for everybody that's in your properties are either in a disregarded LLC that rolls up to you directly, or they're all on your personal name. And so you have years of tax records showing that for lending purposes, but then you move everything over to a partnership LLC, and that changes your tax return, but that income goes away, kind of like technically on your 1040. Does that confuse a lender in some way? Because I know it's coming from a K1, but that's a new entity, and that K1 doesn't have 2 years of tax returns.
Well, correct. So
typically they're going to be looking at that 2 years of tax returns. They want to see 2 years in the same industry, more so than they want to see 2 years of the exact same entity. I'm
challenging that a little bit, just because I've had a few lenders that disregarded completely some of my entities that got created K1s last year because it didn't have 2 years returns, and they wouldn't even count them into my stuff. But that's the only pushback. Some lenders might count it, but that's the only reason why I'm bringing it up.
Let me explain one thing about this. When you switch your returns up and you start using a C Corp, or you're using the K1 from this LLC, you're 2 years out before you're really going to experience the entire benefit. And the reason why you're 2 years out is because your 1040s, if they're asking for your 1040s, they're going to show the prior activity. And so you're right, Tarl, what you're saying is they're going to see that change. And so what I tell people is, like, you have to think longer term. You're not going to see the immediate benefit of setting up a C Corp or changing an S Corp to a C Corp, because that S Corp is still going to show up in your 2019 tax return, and they're going to ask for that information. You're going to tell them, I converted to a C Corp. That's why it's not on the 2020 return. And they're going to say, well, we still want that information. Or as you stated,
the underwriter's going to go, what's a C Corp? And then you're going to have to go down that road.
So this, if you're doing a conversion from an S to a C, it's going to be a while, 2 years. If you set it up right, as I say, to begin with, then it's going to look a little cleaner for you going forwards.
I think the other advice is that if you're at that level too, would be, this is from what I've seen, is that if you're talking to, you might not be able to go to your traditional Fannie Freddie lender at that point. You might be working better with like a portfolio lender or a credit union that understands it enough, like a commercial lender.
Well, yeah, but remember, these are single family homes we're talking about. If you're dealing with your traditional broker, you're not buying through an entity. You're given personal guarantees on those deals, unless, as you stated, it's a community lender and hopefully people have established relationships with their community banks in their area so they can get some of these better loan terms and have a portfolio loan. So you're qualifying in your own name, and your personal tax return is what they're looking at for the qualification purposes.
Yeah, and the nice thing is with the 2-year thing, you can essentially get around the 2-year thing when you have new types of income if you structure things this way. So, for example, you always introduce me as owner of my company, Scott Built. Scott Built is my C corp. Scott Built owns very few assets, but what it does own is the LLCs that own the assets. So when I wrote my books and I started getting royalty income, I passed that royalty income through an LLC that's owned by my C corp. Suddenly, lenders saw that additional income in year one, and they didn't say, well, you don't have 2 years of royalty income, we can't use this. All they saw was this C corp's been around for 2 years, and it now has more income this year than it did last year. That's a good thing. And nobody even questions that, well, it's a new type of income. So that's the nice thing, is that you don't have to worry about that 2-year thing when your 1040 sees different LLCs every year sending income to your personal returns.
That's correct. Yep, I agree. I mean, you're doing it the right way, which a lot of people, they'll miss that. What you said, that I hope people picked up on, you said, you're flipping, but you're doing different activities through LLCs that are owned by the C corporation.
Yep.
So you're getting the tax benefits. That is, everything flows down onto the tax return of the C corp down here, but each LLC is isolating the activity that it's engaged in. So if you were flipping properties through LLC number 2, I mean, one of the things I often tell people is, hey, after you flipped a property through LLC number 2, shut it down. Set up LLC number 3 for your third flip. Shut it down after you flip, and set up LLC number 4 for the fourth flip.
And the reason for that, just to add some color there, is, let's say 10 years down the road after you flip that property, the basement collapses, and you may have had nothing to do with that structural problem, but you're in the title chain on that property, and a good attorney is going to come after everybody that touched that property over the last 50 years, and your LLC that flipped that property, even though it didn't do anything wrong, could get sued. And so by getting rid of that LLC, you've now reduced your liability.
Yeah, we got a client here in Washington, Tacoma, flipping 3 properties to the same LLC. And he's one of our titanium clients. So he can create as many LLCs as he would need to, and it doesn't cost him anything other than the filing fee. You think he would take advantage of that, the service he paid for, and set up separate LLCs? No, he's like, it's easier just to run it through one. Well, he gets sued because he'd flipped a property. They look at some of the plumbing they did in the basement to remove standing water. A plumber told the buyer, oh, this wasn't built to code, and blah, blah, blah. The attorney jumps in and gets involved, and he shakes the client down. He says, listen, if you don't pay us, we're going to file lis pendens on your 2 other properties in this LLC. And you've got HMLs, and what's that carrying cost going to be like for you when I tie up your real estate? And so he was put in a situation where he ended up having to give back all of his profit that he made on the deal plus some. And he wanted to know a strategy to get out of it. I said, no, just pay it. That's great education for you. It's the wrong type of education to get, but now you understand why we told you from the outset, don't flip multiple properties through the same entity, because when something like that strikes, it's going to impact your business.
So I want to then ask when it comes to that. So not ask, but maybe help clarify people too, is that this all might seem very confusing, right? Depending on where you're sitting on your desktop right now. But I get to speak from personal experience that once you kind of understand this, or have somebody that you're working with that understands it, and you have a process that's built out, a standard operating procedure, just like, okay, well, when we go start an LLC, we hit up, let's say in this case, Clint's company, they go just do it for us. We just got to send them an email or whatever, right? They set it up. We get the operating agreement back to us. We're good, right? And we got our certificate of formation or whatever, and we go flip our house through that and then move on. So once you have a process, it can actually be pretty straightforward. But maybe if you're trying to think, how can I do this all by myself, right? That might be a little bit more challenging. I guess on that note, Clint, how important is it for piercing corporate veil or for LLCs, C corps, all this great stuff, that you need to I guess if you're creating all these sub LLCs, do I need to create a bank account for each one of these LLCs too? Or can I have all that banking roll up to the parent company, or if they're sub disregarded LLCs?
Well, it depends on whether or not you're good with bookkeeping. If you're one of those, you try to handle it at the end of the year, and you give your tax preparer a bunch of bank statements and receipts and tell them to figure it out. No, you should have each LLC collecting its own rents and handling its own books. But if you have a good bookkeeping procedure, you're using a bookkeeping service, then you can minimize that cost of having the multiple bank accounts. I mean, when you talk about veil piercing, not having a bank account, could someone use that to try to pierce the veil? Yeah, they could. But that's only one element. You have to have multiple elements in order to pierce the veil. Courts just do not pierce veils of LLCs for the hell of it. There has to be some strong, compelling reasons why. Typically, blurring the distinction between what is personal and what is business, fraud, misrepresentation. There are reasons why you can pierce it. Not having a bank account, to me, is not sufficient in and of itself, as long as you can show that the income is properly being tracked. And to put, a finer point on that, I've got, I don't know, I think 40 or 50 properties in Houston. I don't recall how many are down there right now. I have one property manager. If I told that property manager, hey, I need you to cut me 50 checks or 50 wire transfers, is what he put. He's going to say, go pound sand.
Oh, yeah.
We're not doing that. So they only give me one wire transfer a month. So where are you going to stick it? I stick it in the management entity that manages all of this stuff. And then my bookkeeper goes through and breaks it all out and figures out the CapEx on each property and all that stuff. And so I don't run it through the individual LLCs. It's just impossible to do it with the way that our books are run with our property manager. So one of the strategies that sometimes I'll talk to people about is, as your portfolio builds, your C Corp can perform that service for you. One of the things that you could consider is, if you had 7 properties, and I just picked that out of the air, you could enter into a master lease agreement between your LLCs and your corporation. So what you're doing is you're saying, my LLC is going to lease my property on 14th Street to corporation. The LLC number 2 will lease the property on 18th Street to the corporation. So your corporation is leasing all of your real estate from you. Then it turns around and subleases out all the property to the tenants. You could do that. It's not uncommon to find situations, especially if you're looking at getting involved in a DST where they're running a 1031 exchange. Many of those are built around master leases, because in order to ensure the 1031 exchange treatment, they have to structure these deals in such a way to ensure that they have grantor status back to the investors, so they qualify for 1031s. I mean, this is the stuff that's being done at higher levels, but it doesn't mean you can't do it at a lower level. Just because you're not at that level yet doesn't mean the strategy shouldn't be considered for what you're doing.
So,
okay, are we ready to move on? Because I have more questions.
Well, let's start asking some. I mean, I like this because I got lots of questions too. I can start throwing all sorts of darts. I'm not going to yet. On this portion, so we're going to buy and hold, just so we can put a bow. So we talked about flipping. Got to do C Corp. Cool. Buy and hold. You're over. Yeah, every strategy is different for each person, but like for the most part, you're explaining for yourself personally. Myself, I do this too. We have a partnership LLC that owns individual sub LLCs. That each sub LLC is basically a property, right? And then we're getting taxed as a partnership entity in that case for our rentals for buy and hold. And we overcame some objections on that and challenges. Any more input you want to put on that strategy for buy and hold before we start digging into a lot of Q&A?
Well, I saw there's a question on the series LLC. So that's another form of entity you could use. And if, let's say you're in Texas, which recognizes a series LLC, and you're making your investments in Texas, then I would change my strategy for a Texas investor. In that situation, I would set up a Wyoming holding LLC, taxed as a partnership, and I would have it own 100% of a Texas series LLC. And I'd create individual cells for all of my properties, and each of those cells would be owned by the parent. That's how I would structure it. to accomplish the same thing. And if you're not familiar with the Series LLC, I don't think we have really a lot of time to go into
I've
it.
never even heard of it, so I don't.
So it's the same thing as having, let's say I had 10 properties. Instead of having to set up 10 separate limited liability companies, I only have to set up one. And then it gives me the flexibility to create these cells that are not filed with the Secretary of State. They're separate little operating agreements you set up on the side. You give it your own name, and you can transfer title into that cell. And it's treated as a separate LLC for asset protection purposes, business purposes under the state statute.
Got it.
It's super cool, and it's not supported in any of the states where I do business, unfortunately.
Yeah. Right. So it has to be supported in the state. Well, do you buy property in Florida?
I actually just started buying property in Florida this year. So
Florida doesn't have a statute, but they still recognize the cells.
good to know. Thank you.
But you could use land trust there. I prefer to use land trust anyways. I think, doc stamps and all that.
Yep. Okay, so I want to move on because this is basically turned into an episode where you're dispelling some very common beliefs, dispelling myths in asset protection and tax in real estate. Here's another one that I think a lot of people fall into, and that's this whole idea of I buy a property and I want long-term capital gains treatment on my flip, so I'm going to hold it for 365 days. Can you talk and dispel some myths or just provide some education around if I buy a property, and my intent is one thing, what happens when I change that intent? Let's say I buy a property that I plan to hold, and then I get an offer that I just can't refuse to sell it, and I sell it. Am I paying the long-term or short-term capital gains as a buy and hold? Am I paying ordinary income as a flip? Should I be holding a property if I buy a property and I don't know what I'm going to do with it? Do I put it under my flip entities, or do I put it under my buy and hold entities? That sort of thing. A lot of situations where people buy and then things change in the process.
Yeah. So first and foremost, if you're buying and you're using a C Corp and you intend to hold the property, then you need to get that property out of your C Corp, or I would say even your S Corp, your flipping entity, before you file a tax return. Because once that property hits the tax return, it's staying in that entity for the most part.
I want to also say before you also finish the property too, if it's a rehab.
Yeah. If you know that's going to happen, you got to get it out of there.
Yeah.
If it's a flip, leave it. If you know you're going to sell it. So the intent that you brought up is the overriding test. Why did you acquire the property? What was your intent when you acquired the property? Did you intend to flip it? Do you intend to treat it as an investment? So first off, they look at the taxpayer's activity. If you're a person who flips real estate all the time, then the presumption is you're a flipper. But we don't want you to be classified as what a flipper is, which is the technical term is dealer. We don't want you to be classified as a dealer. That's why we have that corporation set up. So the corporation's a dealer. I want you to be an investor.
I always wanted to be a dealer.
What type of dealer?
That's a whole separate set of legal.
That's why you got audited, because that was a cash-based business you were in. Dime bags.
Pokemon cards.
Yeah. So what ends up occurring is that people come up with these strategies. Hey, I'm going to do a slow rehab on this property, hold it for a year, then sell it and generate long-term capital gains rather than ordinary income, active income on the sale. And you could do that until you get audited. You'll probably be just fine. But if you get audited, what they're going to look at, they'll say, well, why did you buy the property? And then you're going to say, well, I bought it as an investment. Well, no, you were actually working on it the entire time for a year. How is that an investment? That looks like a property you're going to flip. Did you have any tenants in the property? Did you advertise it for rent? And if you're not checking off all the boxes that an investor does, then it's a flip property. And that's how they're going to look at it. And you may think that, there's a case I use in my presentation on every so often to put a point on this, where an individual bought a warehouse on this land, I think it was in Colorado, and he intended to flip it, turned it in, started renting the property, didn't flip it. But every year he performed a feasibility study on the property to see if the market conditions were right to flip it. He did that for, I think, 4 years, and then he sold it. He was audited, and the IRS deemed it was a flip property, not a long-term investment. And the taxpayer lost. And what he lost on was the way he treated it. They said, an investor doesn't perform a feasibility study every year to see if the market conditions are right for sale. That is what somebody who flips property is going to do. So an investor buys it and this collects the long-term, the cash flow and the long-term appreciation. So you have to be cognizant of that, how that's going to hit your return, putting the proper activities in the right entity to ensure that you yourself are going to be treated as an investor and not a dealer. So as things change, let's say I did hold the property for a year, treated it as an investment for a year, and then I sell it a year and a day. Is that a flip property? No, because your intention was to treat it as an investment. It just so happens that somebody came up to you, you didn't advertise it for sale, you got an off-market offer, and you sold it. That's fine. But if you were advertising it, let's say you had it on Craigslist for sale, or
the MLS
back page, and the thing sells, and they see it, they're going to say, no, your intention was to sell that property. Mm-hmm. So it turns on intent, and they look at the facts and circumstances around it.
So, Clint, do you have time for a bunch of Q&A? We have a lot of questions from from a number of the attendees.
I can. Do you want me to take the screen off or leave it on?
If you're done with the screen for now, we can always bring it back and get back into it. But before we get into your for the Q&A, so you have if people wanted to actually, you have a special offer right now, right, for people to be able to do something with you guys at Anderson Advisor before we get into all the Q&A. If people want to get in touch with you or also get in touch with your offer, can you explain that briefly?
Yeah. So if you want to set up a strategy session with us to talk about everything I've been describing, you can go to aba.link/SS12. What it's going to do is it's going to get you a strategy session with Anderson. And what we're going to ask for is we're going to want to we're going to want some information from you about your investing, have you fill up a strategy session questionnaire. I mean, let's face it, if you don't want to provide us any information, then we're not going to have a conversation, because in order to make it productive, I need to know what you're doing, all right, and where you want to go with your investing. And then we're going to analyze it and make some recommendations. Everything that I've been talking about and what I've been drawing out, that's what we're going to do with you. We'll spend 30 minutes to an hour to look at it. And there's no cost for this. I mean, granted, we want to make you a client. If you're an investor, that's what we like to do at Anderson, is bring people in and help them get structured properly. But the way I approach it is we'd rather educate you first. And then when the time is right, either you use us or you use someone else, but at least you're setting the plan up as I would consider to be is the right way. And you're getting the advice from individuals who are investors themselves. We're just not book smart, and pull stuff out of law review articles saying, oh, this has got to work. This is real world stuff, because as I've shared with you, we're active investors and we're closing on deals all the time. So that's what you're going to gain from it. Yeah.
And let me recommend to anybody that's going to go out and talk to Clint, or anybody that's a tax or legal professional, be prepared to be an active participant in the discussion. Go in there before you, you set up the appointment. Before you go in, spend a couple hours really thinking about what your business is, where you want to be, what you've done. Be prepared, because you can go in and say, hey, Clint, just teach me stuff. And he's going to say, well, you're not ready. And that's not going to help anybody. So go in there, really be prepared with what you're doing and what you want to be doing. And again, just be an active participant, because a lot of people ask me, like, I know more than 99% of people out there when it comes to tax and legal stuff. I know 1% of people like Clint. But people ask me amongst the laymen why I know so much. It's because I talk to my advisors and I listen to them and I ask questions, and I'm an active participant in all of this. And so you're not going to get anything out of it if you just go in and say, hey, Clint, just take care of all this for me. I mean, maybe you will, but he'll probably charge you a whole lot more if you just want him to run your life for you. So.
I will also add that I am definitely a frugal person for a very long time in my life. I overcame the DIY plague, and what I've learned is that you get what you pay for one, right? But two, if I had to spend any money anywhere, like especially today in my business, to make sure that I'm getting the right stuff situated, first off, it's my bookkeeping. Second, it's actually my tax and asset protection. Like those are pretty much in that order for me, at least. and I will pay for that, right? Because I've already paid for that in the past by not paying for the right experts in that advice, and it's worth the money, like totally, especially as you grow.
Absolutely,
Absolutely.
100%.
Yeah, I've had a horrible CPA, right? I've also been a DIY asset protection dude for a while, like in the past, and I've had bad advice. I've also had a really horrible bookkeeper, and I've had really great ones, right? And I pay for the good ones. So, me personally, but
and a great advisor will do the things that Clint is talking about. They're not just going to save you the most money and get things done quickly, but they're going to make your taxes look appealing to lenders and to potential partners. And if you're ever going to sell a company, they're going to make sure that your books are sufficient to actually go through a forensic audit. So I mean, these are things that, yeah, you can read a tax book all day long, but these are things you'll never think about that good advisors just will naturally do for you.
Yep. And so, all right, let's get into some of these Q&As. Definitely, guys, sign up for his strategy session. And with his company, it's worth it. It's free for the strategy session. So, come up there prepared, like Jay said, bring your questions, have an idea of what you want. Even if you don't, still talk about it anyways, because they can maybe help direct you with what you're looking for and what you should be doing in your unique circumstance. And we're all unique snowflakes in this business, and they'll help you figure yourself out. So, anyways, so our good buddy Scott Hawley, what's up, Scott? Haven't talked to you in a while. He's had this question for a while up there. We kind of addressed it already to a degree, but he did bring up an interesting point as well that I thought we'd ask. Like, having an LLC only, right, in one of your properties for buy and hold, versus a property in your name with the umbrella insurance, because you don't really get umbrella insurance from an LLC, correct? Because that's for your personal self.
You get a commercial umbrella policy.
Mm-hmm.
Okay. That answers that question.
You got National Real Estate Insurance Group, Chubb. You can go out to them and get a blanket policy against all your LLCs.
Yep.
And you're right. If you're trying to work with your State Farm agent, it's not going to happen.
Got it.
And let me throw something out. And I'll obviously, anytime I say something wrong, I hope Clint will correct me. But there is one time when holding properties in your own name might make sense. I tend to say, like, especially if you're going to do a long-term hold, one of the things that should be driving your decision on how to hold your property, whether it's personally or in LLC, is your lender. So there are some lenders out there who will prefer that you are not holding your property in an entity. Most want to see it in an entity, which is another great reason to do so. But if you're working with a lender, talk to your lender up front. If you're working with a lender who for some reason says, no, I prefer to lend to you in your own name, that's a reason why you may want to hold a property in your own name. And there are some ways to reduce your liability risk in that situation. And so if you're in that situation, again, talk to somebody like Clint. But that is one situation where holding in your personal name might make sense.
All right. Scott asked another question. If you have multiple members in an LLC, or actually, let's throw not just LLCs, let's talk about S Corp, C Corps, all that stuff. How important is it to carefully document your meetings, minutes, decisions, all that great stuff?
So whenever you're in a joint venture, my recommendation is every meeting you have with your partners, you do it via a Zoom conference call that is recorded. Best thing to do. Because
what if you're just BSing the whole time?
Doesn't matter.
Right.
Yeah. Because somebody's going to say, hey, remember that meeting? We agreed that I was going to get 40% of the profits on the sale. And all you guys were doing was talking about what you're going to drink or what type of whiskey you liked. And if you don't have a recording of it, you can't prove, disprove what was said there. So I would, have that recording. Here's the thing. Back for about 7 years, when flipping was really, really hot in California and, around the country, a lot of people out there, talking about flipping. I worked with a lot of people who are getting involved in joint ventures. And no matter how many times I told them, you need to know the people you're working with, vet them, document everything. A lot of people get so caught up in the honeymoon that they lose sight of the fact that this was a contract, this is a marriage, and you're going to have issues that come up. And what ended up happening in many of these situations is that they ended in divorce. And many times it's the person that puts in the money. They're the ones that are getting screwed out of the deal because you had all the skin in the game and you're going to get hurt. So yeah, you got to use your due diligence on that. Number one. Number two, make sure you have a well-drafted operating agreement that touches on those pain points and those expectations that you have for each partner. Because if you don't, it's going to hurt you later on.
And that doesn't have anything to do
Contracts
with
are for when things go wrong, not when they go wrong.
Yeah, that's actually right. So it makes also friends stay friends. But that's you're talking specifically about like partnership disagreements, it sounds like. But what about like, does that have any benefit for piercing corporate veil situations or anything like that about documenting minutes and meetings? And
if you have a corporation, technically LLCs aren't required to have meeting minutes.
Got it.
You still do it when you have multiple partners. It's the safest way to protect your company.
Yeah, everybody should keep in mind when we say C corps and S corps, unless you're in a real special situation like you have a lot of shareholders. Typically, what we're talking about in the real estate world with S corps and C corps is just LLCs that elect the tax S corp or C corp. So basically, the state still recognizes the entity as an LLC, not a corporation, but the IRS recognizes it as an S or a C corp. So from a doing meeting minutes and all those other things, all those administrative things, that's what the state cares about. And from the state perspective, you're still an LLC, which has a much lower bar for those things.
Excellent
but the IRS still sees it as an S corp or a C corp, and they don't notice a difference from their perspective. It's exactly the same.
You just threw a loop for a lot of people. Are you like, oh my God, what? LLCs are C corps and S corps too? No. Okay, so here we go. We talked about piercing corporate veil. That's good. I don't know that one. What about putting each property in real estate privacy trust? What's that?
Yeah, she's talking about a land trust in that example. You can put properties in land trust. I'm the opinion of this. If I don't need to use a land trust, then I'm not going to use one because I can get the same privacy with a limited liability company, the way I structure them. So the less moving parts, the issue you have with privacy trust or land trust that a lot of people don't talk about is when you sell the property, okay? Because what is title asking for when you sell the property? They want a copy of the trust. And so if that trust looks kind of janky to them because they're not used to working with those, or maybe you're selling it and the buyer's using Chicago title and they can't get title insurance because it's held in a land trust, which comes up. So you may have put yourself in a situation where it's going to make it difficult to get rid of the property, or when you do sell, title cuts a check to the name of the trust. Now you set up your trust, and you don't have a bank account in the name of the trust, so you can't get wired proceeds. You got to get a physical check. That physical check comes in. Now you got to go down to the bank and open up a new bank account in the trust just to deposit the funds, and then pull them out the very next day, and then turn around and shut the bank account done. So a lot of the setting all this up, you have to think through all of that. Mm-hmm. And so, there's techniques that we utilize, the way we structure things to help minimize that. Again, this all comes from personal experience because I bought properties in land trusts. I've sold properties in land trusts. I've been through the issues where I faced everything I just described to you, and I had to find solutions to it. And there's always different ways to handle it. But it's not a one size fits all. And if I personally can get away without not having to use a land trust, I will not use one. I'll just put it directly into the anonymity compliant LLC.
Awesome. This next question is from Tao Lee. And I actually like this might have been glossed over, but I like this question because it was actually a concern it's an actual situation that I've had more than once. And it has more to do with when I'm signing settlement docs or closing docs and stuff with title and escrow. But when you sign leases for a separate LLC that's basically owned by the let's say Wyoming LLC for anonymity purposes, how do you sign on behalf of the Washington LLC when you're the member of the Wyoming LLC, and then the Wyoming LLC is the member of the Washington LLC, and you're signing on behalf of that? Wouldn't this erase anonymity since now your tenants, or in this case, let's say settlement statement shows that the Wyoming LLC exists and that you're the member manager of it? And for the Washington LLC. Okay. Does that confuse everybody enough for signing signature?
I had one of my clients yesterday send me an email with a copy of a HUD. And he said, well, I have your structure all in place with the Wyoming LLC owning the state-specific LLC here in Georgia. But I guess it's not that there's not that much anonymity here because look at my HUD statement. You have me signing as Tarl Yarber, manager of Wyoming LLC, as the member manager of Georgia LLC. See, they have my name. I replied back to him. I said, can you tell me where that HUD is filed on which state database that somebody's going to be able to look it up and trace you back to it? And his response was, well, I don't know where it's filed. And I said, why don't you figure that out first before you make the assumption that they're going to be able to track you back to that document? Because it's not. So
what about the deed, though?
Well, the deed, remember, so this is a good question. So people often ask, well, what about the deed? Who signs the deed? Grantor signs the deed, not the grantee. Mm-hmm. So if you're transferring real estate into an LLC or you're buying in the name of the LLC, your name isn't appearing in there. You don't have to sign the deed. It's only the grantor, the person who's transferring you the property.
Yeah, so this is actually, so I like that you said all that. Now, for me, it always pissed me off. We said we have a bunch of LLCs and we have our Wyoming entities and stuff like that. And I'm like, especially with I'm not going to share the name of it, but like it's one I enjoy. But it always upset me when I kept seeing like these long signature lines for that. And I'm like, we got to solve this. So like one thing that you came up with, Clint, was that you made me the president of each one of those sub LLCs. Yep. So that way we don't even need to mention the Wyoming LLC at all, because I'm signing as the president of the sub LLC instead. Right. And I just become a corporate officer basically of that sub LLC. And that you still have to educate title, sometimes so that they understand that that's what's going on there and they leave it off the docs. And if you don't catch it, they'll just throw it right back on the docs anyways, because they just, whatever, this is what's normally done. For me, I'm kind of stickler on that. So I like to not sign as my Wyoming entity. So if I could avoid it, for me, right? But that's how
that's why we did it. And we do that for majority of our LLCs that are set up the way you described. If our client wants it, we will appoint them in the setup as a president of that limited liability company with the authority to engage in all the transactions that the manager could employ for the disposition of real estate.
Especially like in our case, like my wife, Grace, is also another member of one of our Wyoming LLCs. But I'm not saying the name. And if I'm going to closing table for all these properties all the time, and now all of a sudden they have to say, now you have the docs for that, and the member of that also is your wife, and now she needs to sign something, and that's like, it's a headache. So for us, having that document so that I can just sign everything makes it tremendously easier for our lives, at least. So,
well, see, that's important you bring that up, because there's a lot of things that we do on the back end when people are looking to either buy in the name of an entity or sell in the name of an entity. Because I know what's going to happen with title. You want to make sure that you're going to be able to get that transaction closed, that closing date. And so if it means transferring the entity out, changing something in a document called a restatement, so that we then provide title, a clean doc that they're happy with, that's what you do. I mean, I do that with my land trust. I do that with LLC operating agreements as well. Before I sell the property, because I know going into it, hey, if I do it the way I originally had it set up, they're going to have a heart attack because they don't understand it.
Mm-hmm. Love it. Here's a question. I guess this is state-specific question. Stephanie Yang is asking, LLCs seem more expensive for buy and hold than using an umbrella with a trust. Can you explain the LLC per property a bit more? I guess on a cost-wise, I guess I'm originally from California, right?
$800. $800.
$800 minimum for California, right? And so that's an interesting argument, I guess, is that if you have a bunch of properties in California and you're paying $800 per LLC minimum at that point per year in California, like, is that still a good strategy, or is that just for a cost analysis? Or?
Well, there's things to consider there. So with California, what you can do. Actually, I just posted a video on my YouTube page about this. You could either set up a disregarded limited partnership in California, and we don't have time to go into how you do that. Set up a disregarded LP. It's not subject to the franchise tax, or you set up a Wyoming statutory trust. Some people use Delaware statutory trust, and you treat it as a disregarded trust or a grantor trust for federal tax purposes, and you can get around it.
I guess the true answer to that is that's why you have super duper awesome professionals like Clint Coons and his company to be able to help you figure that out, and why you have strategy sessions with them, and why you talk to them, and why you pay these type of guys money to figure this stuff out for you so you don't figure it out yourself. That's the answer. All right. Let's see. We already got that one answered. I will answer one more, unless Jay, you got something you want to ask right now? No?
Nope. I do have one quick question.
Go for it.
Super quick. What is that software that you were using, the drawing software?
That's called Flow by Moleskin, and it's on my iPad.
Okay, thank you. That's
Yeah, I get a question about that at least once a week.
that's pretty slick.
Yeah.
So I guess one question I'd have, Clint, right, is that you said that day one, right? Is there ever that people should just do C Corp, especially if they're flipping and so forth? Is there ever a situation where an S Corp is just a better scenario for them in their real estate business versus a C Corp?
I'm a fan of C Corps, but I mean, yeah, there can be. It just have to look at the situation to make that determination through a strategy session. You'd have to just run the numbers.
Here's another thing. I don't know if this is true, but I'm under the impression that with C Corps, well, I know under C Corps, all medical insurance premiums are fully deductible. I think they may not be under other entity structures. So if you're paying your own insurance, I mean, that's a good $15K a year for my family and me. That's a nice deduction, which offsets some of the other stuff right there.
Good point. All right. Well, guys, if you have lots of questions still, you can, of course, go click the link. And then you click the link to go to set up strategy session with Clint and his company. And if they really, really like you, they'll let you talk to Clint. And so just be careful there. But anyways, so Clint is also, there's a lot of people that if we started name dropping, Clint is the attorney for many of the people actually that we've had on the show before. And that's helped us out. So there's a lot of credibility there. So definitely check out what he has. And talk to his company as soon as possible, right, for yourself, especially since 2021 is coming up. Actually, there's a good question. Is there any last minute tax tips, strategies that we could be doing in the next 14 days before we're all, screwed out of 2020 and our tax abilities or whatever?
So you want to look at cost seg. It doesn't matter.
Cost segregation.
Cost segregation on residential, commercial. It doesn't matter. I would look at that strategy. I would look at possibly using a nonprofit. If you had a really good year, maybe set up your own 501c3 to provide affordable housing, throw some money in there, get a tax deduction, take that money and start using it to invest in real estate. Don't pay tax ever again on your profits. If you've sold an asset, say it's stock, maybe look at a qualified opportunity zone fund where we set up an LLC that qualifies as an OZ fund, opportunity zone fund. And then you've deferred your taxes. So you got 180 days to look at opportunities to reinvest those and not pay any tax on those reinvestments. So those are some. And I shared with you the management fee strategy as well. If you have a corporation, you put together an agreement where it could, C corporation can pull money off. Then that defers taxes as well, gives you more time to spend those funds to get a deduction for them. And the last thing would be if you've got active income, consider a solo 401k plan. Or a SEPI or something like that to get your money socked away in before the end of the year. So there's ways to do it.
Yeah, that last 3 minutes, we should just clip and just say, here you go. Just play that out for everybody. Here's what Clint says to do in the next 14 days. Go. And which is really cool. I love that. Thanks, Clint. How could anybody get a hold of you, follow you, listen to you, learn more besides the link that we provided?
Well, if you go to the link, and then what'll happen is we'll have your name in your email, and then we'll hit you up with our future events that we'll be running. We run an event, 1 to 2 events every month on a Saturday. It's a full day on all the questions that you've been asking. We cover that in depth during that 1-day tax and asset protection event. And then if we have a live event in your area, we'll notify you of a live event once we get back to teaching our 3-day live classes again. So that's what I would recommend. And then check out my YouTube as well.
YouTube's Anderson Advisors or Clint Coons?
It's Clint Coons. It's Real Estate Asset Protection. I forget the name of the channel.
I think it's Asset Protection.
You just type in my name in YouTube. You'll
just Google me, right? That's literally what you just said. Anyways, and Jay Scott, how can people get a hold of you? Or do you have any last minute thoughts that you want to share?
No, I spoke less on this episode than I have on anyone since March, and I probably still spoke too much. This was awesome. Thank you for being here.
Thanks for having me on, guys. Appreciate it.
This was great. And anybody who wants to connect with me, it's easy, www.connectwithjscott.com, and that'll send you out to any link you want to find.
And I'm Tarl Yarber, and we have next week, the Brandon Turner joining us with bigger pockets. He's kind of a big deal with a big beard. And we'll be seeing you guys next week at noon Pacific Standard Time, Wednesday once again. for the show. So tune in for us next week. And you can also follow me at Tarl Yarber on Instagram. And we will see you guys next week. Thanks, Clint. Merry Christmas, everybody. And happy Hanukkah, happy holidays, happy everything.
Thanks, Clint. It was awesome.
Bye, guys.
Bye, guys.
Bye.